So, what is an encumbrance? So, basically, an encumbrance is a financial commitment, and this actually plays an important role in budgetary accounting for a governmental entity. For a for-profit business, when a company receives any commitments or receive an order from a customer, you usually do not record it. But for governmental entities, you have to record these financial commitments, and those are referred to as encumbrances. Because the main idea is that if you record those, that will give you some idea about your funding, and so that you can do your controlling later, so that you don't overspend. And Gatsby really emphasizes that you have to record these encumbrances for your budgetary control purposes. So now I will take you to the textbook, and from now and for next few topics I'll show it mostly from your textbook, and we'll go over some journal entries. I am showing you your textbook, page number 754, and this is an example how to record these encumbrances. Here, this is the illustration that a city's police department orders $18,000 in equipment from an approved vendor. As an ongoing service activity, the police department is accounted for within the general fund. Now, definitely we will record it, and it's of course within the fund financial statements. If it would be a for-profit company, when you receive an order or you place an order, usually you should not record it. But Gatsby says that you have to record it, and you will record it as an encumbrance. So let's see the journal entry. And they define it, it will be within the general fund. Remember, when you will do the fund financial statement for fund accounting, you, and especially when you are doing the journal entries, you have to check it will go under which fund, and you have to label that fund properly, because for a city or for a state government, they have different type of funds, governmental funds. And if you think of the balance sheet and their revenue expenses, what we just saw, they actually present all these according to fund wise. So basically they will present different columns for their major funds, and they will add them all other funds. So you have to specifically know what fund it is, which fund it will go, and you have to label it. So when we will record these encumbrances, it is a little bit different. You probably didn't see this type of entry before. This is the label for fund type or fund's name. It's general fund, and it's for the police department. So they are labeling it correctly, properly. And then they will debit encumbrances, and they will also write it down next for which what item it is for equipment. So they will debit it, and then they will credit encumbrances outstanding. So you are not receiving the equipment now, so you cannot record this equipment. So we are calling it encumbrances. We are debiting it as an equipment encumbrances. Now, since you didn't receive the equipment, now at this point you are not obligated to pay anything. That means at this point, when it is just an order, it doesn't create any liability. So you are not recording any accounts payable, notes payable, or voucher payable. So you are crediting as an encumbrance outstandings. Now, later, when you will receive that equipment, that will create your actual liability, and you have to record the liabilities. So they are kind of estimating that the equipment will cost $18,000, but now really when they will complete the deal and receive the equipment, the money can be different. So what happened here, when they received it, they actually found that here the cost was 18,160. Now, what they will do? They will remove that encumbrances entry. They will remove that. That means you have to do the opposite entry to remove that encumbrances. Remember, initially we debited encumbrances equipment, and then we credited encumbrances outstandings. Now we physically received that equipment, so we will remove it. We'll do the opposite things. That means we're gonna debit these encumbrances outstandings, and we credit encumbrances equipment. So we are kind of canceling out the total entries, and now we are showing the actual receipt of that equipment. So what you need to do, first, you have to record that equipment. But look at this. Here, you are not recording that equipment as an asset. Rather, we are showing it as an expenditure. Remember, we are talking about fund accounting. So for fund financial statements, your main focus is your current financial resources. How your resources reduced or increased. This is all current years. So you should not record those as long-lived or fixed assets. Rather, we are just kind of justifying this payment, this item as an expenditure because we are current year focused. So we will debit it as an expenditure, and again I will write equipment next to it, and then you have to record the real liability. Now you receive the equipment, you have to pay. So you are creating this liability and recording it so you can credit accounts payable or voucher payable, and they showed that the amount is a little bit different, but that's totally fine. Now we will record the actual cost, and this is how you will deal with encumbrances and you will deal with those journal entries. So what basically happened here, if I go back to the slides, basically the governmental entity will first do their budgets, and then they will see how they will finance everything or how they will use those amounts or what are the sources they can use those. Then if they have any commitments and anything, they will record these encumbrances, and then later this is their actual expenses. Remember, fund financial accounting, here we are focusing mostly on governmental funds, and we just learned the concept of encumbrances, and I also showed it to you how you need to do the journal entries when you record the encumbrances and when actually you remove it and it's no longer a financial commitment, rather you actually receive or you deal with the physical items. So far we learned about encumbrances and how you need to record it, and when you actually received the physical item is received, how you need to remove that encumbrances and you need to record everything as an expenditure. Remember, fund financial statements or governmental funds, they focus on your current year's resources, and that's why they will record everything as an expenditure. And that's actually a little bit different if you think of the government-wide financial statements. So if you want to compare the encumbrances procedures for a fund financial statement versus a government-wide financial statement, so you will see that for a fund financial statement, you have to record the entry when it is just a commitment, right? Just an order. So we record it when it is an encumbrance, and then we again record it when the item is received, and then we remove that encumbrance journal entry. But for the government-wide financial statements, we actually do not record anything when it is an encumbrance. We actually record it when the order is fulfilled or when physically any item is received. So this is one difference between fund financial statements and government financial statements in terms of encumbrances. So here, what I am mentioning and repeatedly am trying to explain is that fund financial statement actually focuses on your current year's resources, current year's performances. So basically, we actually do not record any capital assets or any fixed assets. Whenever there is any acquisition, we actually show it as an expense. So if you think of the balance sheet of a fund statements, you will see that there is no actually long-term assets. I can take you to the previous slides where we saw an example. This is fund financial statements balance sheet, and you will see that there is no long-term assets, or actually there is no fixed assets, because we do not record any assets, any capital assets or any long-lived assets. But for governmental wide financial statements, yes, we record it. We show the entire governmental entities' financial resources that, of course, will include your short-term and long-term assets. But again, for fund financial statements, our focus is only on current year's resources. So now here comes the question then how we should record a purchase of an equipment or a purchase of any long-term asset vehicles, or how it will differ from other regular general expenses. Basically, there is no differences. The way you record the way you record an utility expense should be the same way you will record the purchase of a truck or an equipment. So I'll show you a couple of journal entries and I am taking you to our textbook. So here, the textbook examples is again fund financial statements, page number 756, and it shows that they spend $1,000 for electricity bill, which is pure and utility expense, and then at the same year they actually acquire an ambulance and they paid $70,000, but they will treat both items in the same way. That means when they're gonna record this utility, they will treat it as an expenditure. Again, they will show it expenditure and they will label it utility $1,000 and accounts payable, or they use the term, this is very widely used the term in governmental accounting, vouchers payable, which is nothing just like the accounts payable. It's a liability. So they will credit liability. And they will treat the acquisition of ambulance in the same way. They will again record it as an expenditure, and this is an ambulance, $70,000, and they will credit voucher or accounts payable. So remember, fund financial statement, fund accounting actually follows the modified accrual basis of accounting. And according to modified accrual accounting, you have to record an expenditure at the time when it creates a liability. That means you are creating a claim against your current financial resources. But on the other hand, if you think of the government-wide financial statements, which follow like regular, typical accrual basis, and you will see the same treatments, the same entry, same transactions, but a different treatment. But again, for fund financial statement, our focus is only on current years. So for that reason, again, any type of expenses, salaries, rents, or any type of purchase of any fixed assets, even like building, machineries, equipments, other capital assets, everything will be treated as expenditure. And we just saw that for their balance sheet, you will not see any long-term assets because whatever they spend, they treated everything as expenditure. Since there is no long-term assets in fund financial statements, you will see that they actually don't compute or show any depreciation. So depreciation is totally omitted. But now, if you look at the government-wide financial statements, you will see which actually follows the accrual, typical accrual accounting, just like the for-profit company. They will record this utility expense as an expense and accounts payable or vouchers payable. And for this ambulance, they will record it ambulance, which is treated as a long-term asset. And they will credit vouchers or accounts payable. So now we discussed this how the fund financial statement actually records these expenses, regular expenses, and how, why, and how they treat this type of acquisition of long-term assets also as an expense. Now, how about how about supplies and prepaid expenses? Because for supplies and prepaid expenses, those are what we usually do for-profit institutions. For for-profit institution, for we actually show those as an asset. If you pay the prepaid expense or any supplies, and then later we actually take how much we consumed and then we reduce that part. So I am talking about these supplies and prepaid items, and if you check your textbook, it is around page number 757 and 758. So this is a little bit complicated here because here they actually can do it into two ways. One is called the purchase method, where they will show the entire purchase as an expense, and then if anything is remained like unused, unconsumed, unused supplies, or any unexpired portion of your prepaid, they will label it differently. And there is another method that is called the consumption method. So under this consumption method, they will treat the entire amount of their supplies or prepaid amount as they will record the whole amount, and then they will show the expenditure item only for the amount they consumed. So I think if I give you an example, and that's again from your textbook, it will make more sense. So again, for recording supplies and prepaid expenses, there are two ways they can do it. There is no like fixed ways. They are kind of free to use one after another. Some entities may use the purchase method, some entity may use the consumption method. So let's see the purchase method. So the example here, if you read it, that a municipality purchases $20,000 in supplies, and what happened for that fiscal year, actually they consumed $18,000 of supplies. So at the end of the year, the remaining amount of supplies is $2,000. Now how they could record it? So if you follow the purchase method, you have to show the entire amount of your purchase as an expenditure. So they will record supplies expenditure 20,000 and vouchers or accounts payable 20,000. Now at the end they will see that they have still remaining like leftover supplies or unused portion is $2,000. Then they will record that remaining 2,000 as an inventory of supplies, and they will credit it as a fund balance, and they will call it non-spendables because this amount is basically the supplies, right? It is held in supplies, so they cannot spend it for any purposes. So this is the purchase method. Now there is another way to record these supplies. This is called the consumption method. So for the consumption method, they will record the entire purchase as an inventory of supplies. So they are showing this inventory of supplies, $20,000 debit, and then they will credit vouchers payable. Now at the end, they will show the amount that they consumed as an expenditure. So they will debit expenditures, and then they will reduce the same amount of inventories. That means at the end their inventory of supplies will be $2,000. So that is about supplies and prepaids. Now we will focus on revenues, recognition of revenues. So how a governmental entity could record their revenues. So you all know that for any governmental entities, the main source of their revenues is tax, right? So there are different ways they could collect taxes. But now, if you think of these revenues and how it differs from a governmental entity versus a for-profit business, basically for a for-profit business, when you record revenues, you have something is transacted between the company and your customer, right? So for a for-profit business, of course, something is exchanged. That's why we call it exchange revenues. So a for-profit business will record their revenues when they sell their goods or ship their goods or provide any service. On the other hand, governmental case is different because they collect taxes, which is the major source of their revenues, but the moment they collect the taxes, they are not providing any direct service or direct benefit that moment. So this is kind of not, you can say, not like pure exchangeable things happening here. So we call it non-exchange transactions. So now how we could record it? So basically all those revenues and these non-exchange transactions, of course, this is the main source of any governmental entities earning. We actually classify those non-exchange transactions into four distinct categories. One is called the derived tax revenues, which is kind of plain and simple. And a very common example is income tax and sales tax, because these type of taxes occurred when there is some underlying exchange takes places, income or sales, something is exchanged there. So this is under the derived tax revenue category. Now, another is categories imposed non-exchange revenue. So here this tax is imposed and nothing is exchanged here. For example, property tax or any type of fines or penalties. Now there is another category, it's called government mandated non-exchange transactions. So for these government mandated non-exchange transactions will include some grants, and that is coming from another government. Now last category you will see the category of the revenues is voluntary non-exchange transactions. It could be anything, any amount, any fund, any money that is kind of given to any local or state government by an individuals or by any organization. So this is how they will actually classify these non-exchange transactions, and we will see few examples. Of course, most common example is tax revenues, how the government will record that. So I'll take you to your textbook and we will focus on that. And remember, these transactions will be recorded by the government-wide financial statement. So let's see the examples from the textbook.